Hello, and welcome to another edition of Wealth Management Insights. I am Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, March 10th, and I'm recording this from our brand new media studio in Purchase, New York. About 10 weeks into the year, and markets have already given us a fair share of twists and turns. Market narratives have transitioned from the bullish thesis around Fed easing and generative AI dominance to worries about overheating and sticky inflation, and now to concerns about stagflation tied to rapidly changing policy from Washington. Although we are far from endorsing a buy the dip posture in this environment, we are seeing some opportunities below the surface, especially as an economic soft landing remains our base case. Let's consider three areas. First is the degree to which cyclicals have recently underperformed defensives. Tariff-related concerns for industries like autos and materials are understandable, but we see financials being thrown out like the baby with the bathwater. This may create a value opportunity in the sector, which is seeing better forecast earnings growth in 2025 and cheap valuations versus its own history. Also, financials may be among the biggest beneficiaries of Washington's deregulatory push. Already, we're seeing signs of a revival in deal activity, a pickup in commercial and industrial lending, and the potential for net interest margin pressures to be buffered by cost-cutting and productivity gains. Second, we see long-duration bonds as potentially overbought. There's been a rally in treasuries alongside the sell-off in equities, with the 10-year nominal yield falling to around 4.3%. Notably, part of this drop seems to be coming from a compression in the term premium. And remember, term premiums have to do with policy uncertainty, and I cannot remember a time in the past 30 years when demanding this premium was more important. Consider not only the rapid pace of policy changes coming from Washington, D.C. right now, but also U.S. debts and deficits are likely to keep growing. What's more, bonds tend to struggle in a stagflationary environment, a rising possibility in the near term. Given these factors, there may be an opportunity to take profits on long-duration bonds. Third, there's been a weakening in the U.S. dollar, and this comes at a time when positive catalysts outside of America are burgeoning. Meaningful fiscal reform in Europe likely to lead to an acceleration in spending and investment, while a stimulus plan for China seems to be emerging. These changing dynamics are creating an argument for adding to non-U.S. exposures. We understand it can be hard to recognize these sea changes, especially for investors looking at the markets from the top down. From that lens, some might say that not much has happened since Election Day, with stock indices and yields basically having round trip since then. But as we know, markets have been adjusting to changes in Fed's policy stance, questions about the Magnificent Seven dominance, and to Trump 2.0. Many investors are currently wondering if this is a buying opportunity. Our answer is yes, it is, but not going back to the old leaders. We're looking for the new ones. With this in mind, consider being opportunistic in the recent market turbulence, adding to cyclicals like financials and domestic manufacturers, including mid-cap industrials. Consider also diversifying regionally across emerging markets, Japan, and select European markets, exploiting the shifting momentum outside the U.S. and funding these both from long-duration rate exposures. Thanks for listening. And for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.